Welcome to Markets Now. I'm Michelle Rook with Craig Turner of StoneX. And we started off with a little bit of pressure in corn and soybeans this morning, but they are back to the plus side as well as the wheat market. Cattle futures have seen a little bit of two-sided trade here already, but we are back seeing a little pressure there. All right, Craig, let's talk about corn and soybeans. Like I said, started off a little bit lower here after new highs for the move yesterday in both markets. So we got a little profit taking and farmer selling before we pop back higher?
Yeah, we definitely had some profit taking a little bit in the corn market coming into this morning, but corn is still tight and we're still going to have a little dry weather for the next couple of days until the rains come back in South America. We looked at the last export report. We're about 5% ahead of pace, according to where the USDA says we should be. Now we hit some pretty big resistant points. There were a lot of orders out there to be selling March at 460, in July either 475 or 480, and we did see a lot of targets hit. We had a lot of farmers selling in South America. The funds were so long. It's natural to have a little either profit taking or just slowing down. Where you're going to have a little bit of an exhaustion on the buy side. So wasn't surprised to see that, but that report on Friday was bullish, and it's going to be supportive for corn and soybeans here for a while.
Yeah, how long does it normally take to get that kind of a shock worked into the market?
Yeah, so they say the general saying is it takes 2 days for a WASDE report to fully trade, especially a big one. And if you think about it, that report comes out at 11 a.m. on Friday. Only the U.S. is open. On Sunday night, we got China. London's going to be opening up at around 2 a.m. So then you have Europe trade the report. So it really does take until the second day of the close to kind of get the full reaction and the adjustments of positions. And so that's what we saw. We saw a 2-day rally, and today we were down a little bit, we're up a little bit, and now we start trading, weather and exports again.
Yeah, so let's talk a little bit about weather. Brazil, at least southern Brazil, looks fairly hot and dry, as well as Argentina. Are we putting some risk premium into the market as well here?
Yeah, we certainly have over the course of the past couple of weeks. When you take a look at the 6 to 10 day weather, we do get some rains in southern Brazil and in Argentina, but we're already hearing some private analysts being concerned about production. I know Conab has been around 165 to 166 for soybeans, but some of the private analysts were about 170. We're starting to hear maybe they're going to walk those down a little bit for where we were saying with corn. So listen, the heat and the dryness has stressed some crops. The big argument right now is if there is a little bit of a loss in Argentina and southern Brazil, and the crops have looked so good in central and northern Brazil, can they kind of balance it out?
Yeah, and I guess we'll see going forward. This is kind of the critical time period that we're getting into now for that crop down there for sure. Okay, you mentioned exports, so let's deal with that. Yesterday we had a marketing year high for corn export inspections. We saw another 7.3 million bushels of soybeans going to China yesterday. Same yesterday and today. I'm sorry, and so we are still seeing demand come to the market, right?
Yeah, demand is coming in. It's been strong. And we're getting to the point here where you can even just see it in the spreads. July is now 30 cents over December for the corn market, which is telling me that not only are we getting a little tighter, but the cash market for old crop has pushed corn up to a place where honestly, when 6 months ago when we were talking about a 2 billion carry out and the possibility of 92 million acres or more for a new crop, to think that July would be trading 30 cents over December, it really wasn't on our radar. But here we are. So demand has been strong. And if you take a look at the pace of exports, and if the USDA has to make another correction for a higher export market, all of a sudden we're below 1.5 billion on the carryout, which is something that the trade will be talking about for the Feb or March WASDE. Will be under 10% stock to usage. And when you do get to 10% stock to usage, any unexpected increase in exports or weather issues can really give the corn market a pop. And there's really no reason for the funds to, come out. They, in that situation, they would probably even hold on or add on if they think we could be below a 10% stock to usage. And while the pipeline for corn was about a billion back in like 2007 through 2012, with the expansion of operations here in the United States, a lot of people think the minimum pipeline is close to 1.2 or 1.3 million now, billion. So we could be tighter than we realize.
With that being said, if the demand continues in corn, $5 corn in the cards, you think?
Well, here's the thing. You got to look at two things. One, if the United States starts getting tight in corn, are there other major exporters around the world that have corn, right? So if they do, then we'll top out at 510, 520, something like that. But if the rest of the world, namely, Ukraine, Brazil, Argentina, don't really have corn for export yet, then all of a sudden, you have to price ration aggressively in the United States because we are basically the world's residual supplier of grain and oil seeds, especially on the corn side. Our Right now, Argentina, Brazil, Ukraine really are on the tighter side of things. The major exporters are projected to be, tight by the end of the year. So if we continue to have this demand and there's weather issues in South America, you could probably, the big target out there for old crop would probably be this 520 or 530 area, which in my mind is the old 450, 440 from before, let's say prices before COVID and the inflation that we've seen throughout the economy. And if you do break through there, the thing is you can't keep on taking ending stocks lower. If the demand, picks up that much, prices have to rally in order to make sure you're shutting off export demand. And that's how you get, exponential, prices higher. We're not there yet, but what it is interesting is we're a lot closer to that level than we were just 3 or 6 months ago. So definitely $5 are in the cards if we continue to see this strength in demand, and if we don't get that rain in Argentina and Brazil, in the forecast now, July could be $5 before you know it.
Does that also suggest we could hit $11 on beans?
So with the soybean market, it's a little bit different. At 380 million bushels on the carryout, you've got about an 8% stock to usage, maybe 8.5. But the market does realize we've got a monster crop brewing in Brazil. Doesn't have to be that way. I mean, we saw the big surprise in the WASDE on Friday. We thought we are going to be 182 or 183 on the corn, and here we are at 179, and the beans got slashed down to 50.5. So anything can happen. And we're saying there's going to be this big South American crop right now, but clearly that can change. At the moment, to get to $11 on beans, you really need to continue to see Chinese buying. I think you have to have the crop in South America a little bit more stressed. Maybe if the private analysts came back down to 165 on the Brazilian crop and got out of the 170s, you could see something like that. But for the moment, when you take a look at the major exporters, there are beans available on the major exporter balance sheet for a little bit loss of supply. While in the corn market, that's really not the case. Like we're getting to the point here where we're tight overall.
Yeah. And we talk about the funds. We already said the funds are really long in the corn market, and in the soybeans, they've covered shorts. Are they flat, and do they actually go long in that market?
Yeah, I think the funds are flat now. On the last commitment of traders, I want to say they were short about 28,000 contracts or somewhere around there. And then the price action since then would suggest they're probably flat. The situation in soybeans in terms of how tight we are and where we could be, I think you got to take a little bit more of a neutral position on beans. I would also say that, with soybean oil, we've been seeing very strong demand in soybean oil and we're crushing for soybean oil, but that also means we may have some meal that's going to have to go lower to basically find a buyer, right? We can't store the meal. So the meal has to actually work its way lower in price to make sure it gets demand if it comes to that. So soybeans are a little bit different because when you're crushing these beans and we're a little bit more neutral, you can have a bullish story with bean oil, but the counterbalance is that you are creating that meal. So I think there's a little bit more of a headwind on between, one because of the dynamic between oil and meal right now, and also the fact that we are still expecting a pretty big crop out of South America for the soybeans. So I'm guessing the funds are flat and they're taking a wait and see approach here.
And we haven't even talked about tariffs and the possibility of that yet as a headwind, but I think we've talked about that in previous programs. So let's move on to wheat. Just a quick question there. The funds actually are a little bit shorter now in Chicago wheat. And I think 2 days ago, we just bounced off contract lows. Do you think that market is put a bottom in here? Can we follow corn and soybeans?
I hope so. Is the my answer on that. But here's the problem with wheat. Or a couple of months ago, we thought wheat was going to be putting in a bottom. The rest of the world was getting tight. The United States would be the basically again just like corn, the residual supplier of wheat. And the way we were seeing things is eventually demand would come back to the United States, and that would give at least supportive for wheat and give it a pop. The problem is the US dollar has really rallied. And if there's one commodity in the grain and oilseed side of things that's sensitive to the US dollar, it's definitely wheat. And it's because you can export wheat from all over the world. And, it's not like South America where you basically have two seasons for soybeans and it's either South America or the United States are in control of that market. So I would like to see wheat move higher. Right now, it is a follower to corn and soybeans. The wheat acres that we saw for winter wheat were pretty much around the expectations. We'll see what spring wheat is. I wouldn't be surprised if spring wheat acres in March were a little bit lower as it loses out to corn out in North Dakota and the surrounding area. So wheat can rally. Right now, it's a follower. What we really need for wheat is we got to see some of this export demand shift back to the United States because the rest of the world is tight. Russia, they're going to have their export quotas. It's still a little bit difficult to get wheat out of the Black Sea. If we could see, India is going to be a little tight this year. If we could see export demand come back to the United States, and it's a show me market, meaning that we got to see the demand before the market can rally. February through April is the best chance for wheat to rally because once you get to May, you got the new crop coming, or at least starting to come late May, or the market's going to expect it for the winter wheat harvest. So if we're going to rally February, March, April, we'll see what happens. I hope it does, but you can, it can be a tough market sometimes for wheat when you got to
Yeah,
carry out.
no doubt. Little dead cat bounce here today. Let's hope we can build on it anyways. All right. Thanks so much. Craig Turner with StoneX. That is Markets Now.